My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to save you some money. My job is not just to entertain, but to put days like today into context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Don't you just want to cut and run after a hideous day like today where the Dow plunged 943 points? S&P plummeted 3.53%. Sell. And the NASDAQ nosedived 3.73%. Wouldn't it be liberating to dump the whole shoot match, cash in your IRA, take down your stock exposure, your 401k, hey, maybe sell S&P 500 index funds to preserve some cash? Perfectly sensible emotion? Sure, but that's the problem. Emotions. Whether you're trading or investing, you can't afford to make decisions based on your feelings. When you sell something just to make the pain go away, I mean, you want to banish the pain. I totally get that.
The house of pain.
You're probably making a mistake. Look, after a tsunami of selling, like we had today, I'm not asking you to stand there and let the wave crush you, nor am I telling you to try to surf it, although I'm sure there are some hedge fund managers who can actually pull that off. I'm simply asking you not to panic, because nobody ever made a dime panicking. Believe me, I know from experience. I've been doing this for 40 years, and I'm not exactly a calm guy. Don't know if you noticed that. But every time I've panicked, it cost me money. And I often end up beating myself up maybe a week or even a day later. In 4 decades, I can only remember one moment when panic was actually a viable strategy, and that was the financial crisis. Even then, panic selling only worked if you were nimble enough to get back in a few months later. That's why in the fall of 2008, I made a rare sell everything call. At the time, the financial system was collapsing, and no one in the government understood the severity of the crisis. Saved people a lot of money. And we got back in on the fabled Haynes bottom, the incredible call to get back into the stock market made by my late friend, CNBC legend Mark Haynes. However, 2020 is not 2008? No, not 2008 at all. Admittedly, there is a confluence of horrors. We've got a runaway pandemic clobbering hospitality, travel, leisure, aircraft, hotels. We've got an election, though, unlike 2008, this one's very tough to game. Thanks to the election, we don't have a stimulus safety net because the Democrats and Republicans refuse to compete and cooperate at the same time. But this is not a sell everything moment. How do I know? Okay, well, let me give you the drill. It's kind of like when a quarterback trying to figure out how to stop the defense from sacking him and still get the ball off. First, you ask yourself, why is the market as a whole going down? Got to have a thesis, a worldview. Right now, it's because COVID has gotten out of control worldwide. So Europe's going back into lockdown. The United States might not be far behind. In other words, it feels a little like March, right? When practically everyone on Wall Street panicked and scared the market into a bottom. A lot of them came on TV. Wish they hadn't. Of course, it's not really like March. There's less panic, in part because the lockdown thesis doesn't really hold water this time. Whether or not it makes sense to shut everything down, very few states have the political will to go through that again. Sure, the bars and restaurants and schools might even close, but states literally can't afford to shut down everything. They desperately need the tax revenue. On the other hand, at least in the spring, we had a stimulus package. If you lost your job, the government effectively paid you to stay home. That was somewhat the point. Slow it down. This time, we're taking what I call the blood simple approach. Down here, you're on your own. Second, we try to figure out which sectors deserve to get hit by this kind of meltdown and which ones don't. Given that it's earnings season, we actually got a good handle on this. We know that a lack of economic activity will send interest rates lower, which means you can't bottom fish in the banks. We know there will be less demand for oil, so that group remains uninvestable. We're not quite sure if we're headed for a recession because a lot of that depends on the election. I think we're going to get a stimulus package eventually, so maybe you can't buy those stay-at-home food and drug stocks, right? And you'd probably get something in January or February. So what does that leave us? And by the way, those other stocks could come into vogue, and I'll tell you if they do. Well, it leaves us with the 5 bull markets I have flagged repeatedly and then summarized on Monday, so you'd be ready for this decline. The ones that don't need a healthy, COVID-free economy to make you money. Yeah, but after that first leg down, we drew up this shopping list, so you'd have something to buy, not sell into weakness. Force yourself. Strap yourself to the mast. In other words, we put it together for days like today. First bull market, 5G. We know that this new ultra-fast wireless technology cannot be stopped by the pandemic or by dysfunctional Congress or White House. It's too strong. That means you should be prepared to buy something linked to 5G. I like Marvell Tech, just reported great number. I like Broadcom, just reported great number. I like Qualcomm. Second bull market is digitization. Last night, we got results from one of the largest companies on earth. This is Microsoft. Every line item, from gaming to Windows to LinkedIn to their cloud business, Azure, was extraordinary. But Microsoft's predictably cautious and brilliant CFO, Amy Hood, whom I've known for a couple decades, chose not to present a forecast that was raised dramatically. Why not? I don't know. I trust Hood's judgment. Maybe she wants to underpromise and overdeliver. Maybe she was being prudent. Honestly, you know what? I don't care. What matters is that Microsoft doesn't need travel spending or a stimulus bill or give an election outcome to beat the numbers. We saw that. All day I heard people complaining that they can't deliver. I wanted to ask them, did you even listen to the conference call? Is it too boring for you? Did you have something else to do? Microsoft shot the lights out. I think you should buy it now before the bears actually read the transcript and figure out what went right. Honestly, did anyone read this stuff? I mean, I know my life's miserable because I read it. It took me about 70 minutes to get to the end of the thing. But that's all right. It's what I do. Speaking of digitization, Pinterest blew the doors off tonight. I remain a huge believer in social media, as you know, as the best way for advertisers to reach kids of the digital age who cut the cord, never cord, and all that other cord stuff. Bull market number 3 is hygiene. There are some of the most straightforward COVID winners out there, yet they got hammered today. Procter & Gamble reported amazing numbers, down more than 3%. Clorox reports next week. This is a company that's synonymous with lockdowns, which is why it was down just 2%. Hey, how about a special situation I've been talking about? El Brands owns a phenomenally consistent Bath and Body Works. Sweet smelling, clean, lucrative. Bull market number 4, home renovation. Doesn't stop. Masco just reported an amazing number, earning $1.04. Street was looking for 78 cents. Masco is all about cabinets and faucets, yet the stock was barely up today. I mean, Masco. They're giving it to you. They're giving it to you. Hey, you know, been waiting to get into the Home Depot? Oh, now you're running from it, right? To the 2.6% pullback that scares you, right? Wrong. There's nothing wrong there. Lowe's is doing its own renovation. I'd like to see it a tad lower before I pound the table. Wait, Walmart never comes down, but now it's coming down. Hoo-hoo, keep you away from Walmart. Final bull market, autos. Then, thanks to the pandemic, no one feels safe using mass transit or even carpooling. Plus, millions of people no longer need to go to the office, and boy, whoever, they're really not going to the office now. They're leaving the cities for the suburbs, the exurbs, whatever they call it these days. It's created a bull market in autos. Now, you got the beaten down Ford, which reported terrific upside surprise this very night, and I bet the first of many by new CEO and car guy Jim Farley. Now, he is not going to tout his horn. He knows it's too early, but I like the bottom that's forming. I want to buy my wife an F-150 for her birthday next week because, heck, sharing is caring. Now, you got Tesla. You can do that one. Hey, how about Lithium Motors? Live. We had them on last week. I thought they'd hold a pretty good tail. That stock's way down, 55 points. Now, of course, you don't have to do anything here. That's always an option. You can simply sit tight and wait for a bounce, at which point you might want to sell some stock to raise capital for the next beatdown. It's fine with me. But here's the bottom line. If you want to be psychologically prepared for days like today, you got to have that shopping list because the market throws a sale just when you, well, least expect it. You can't rummage without a game plan. Too much chance you'll end up buying the wrong thing. So please, if you're worried that stocks will keep getting hammered, be ready to pounce on some of these COVID-proof bull markets rather than saying, I'm scared, I don't know what to do. You know what? And by the way, I'll keep you on top of all of these bull markets so you know you're not alone.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.